Welcome to this explainer. Look, right now, the global foreign exchange market is experiencing an absolute jolt. We're sitting in the immediate aftermath of a U.S. jobs report that came in noticeably weaker than forecast, and, well, it has sent shockwaves right through the trading terminals. You have to understand, this isn't just some minor blip on the radar. It's a fundamental shift in momentum. It's creating massive winners, historic losers, and leaving a few major players completely stuck in the mud. So today, we're going to break down exactly what this data is telling us, who's actually leading the pack, and where the critical pressure points are right now.
So let's dive into the core question on everyone's mind. What happens next? Now, you might have seen that the weaker than expected U.S. employment data initially sent the U.S. dollar into a bit of a slide. But here is the crucial takeaway. That slide has stopped. This macro shock effectively forced the entire Forex market into a sudden rebalancing phase. Instead of going into a free fall, the USD has stabilized. It's kind of like a giant boulder being dropped right into a river. It's forcing all the other major currencies to navigate the diverted currents. To really understand how those currents are flowing, we need to zoom out and look at the whole board.
All right, let's start with section 1, the big picture, and how the market is rebalancing.
When we look at the terminal data for the major USD pairs, it reveals a story of intense divergence. The indicators are showing us that the US dollar itself has stopped bleeding. It's found a floor. But the currencies priced against it, they are absolutely no longer moving in unison. We're looking at a deeply fractured market right now, where momentum is heavily concentrated in a few very specific assets, while others are just entirely left behind. The board is resetting, and frankly, that presents a massive opportunity if you know exactly where to look.
So, who's actually taking advantage of this reset? That brings us to section 2, the leader, where the GBP outperforms.
Right now, there is a very clear strong buy consensus across the technical indicators for the pound. The GBP to USD pair has been hovering right around that 1.33879 mark, which is hitting its highest level in roughly 2 weeks. And you might be wondering why. Well, capital is flowing straight back into UK assets. Driven by this overwhelmingly positive investor sentiment, the pound is outperforming the euro and maintaining a much stronger trajectory than the vast majority of its major peers.
To put that into perspective, if we measure the bounce from the late June bottom, the pound is up over 1.8%. That is a dramatic, aggressive, upward swing in the Forex world. But, actually, hold on a second. As enthusiastic as this looks, the underlying analysis strongly suggests caution. The primary trend definitely remains bullish, but after a climb that rapid, a short-term correction over the next few sessions is highly probable before the broader uptrend continues. Don't let the surging momentum blind you to the mechanics of a healthy market pullback.
Now, this upward surge builds a truly stark contrast with the other side of the market. On one hand, you've got the GBP's massive momentum. On the other hand, you have the historic, frankly, crushing weakness of the Japanese yen.
Which leads us perfectly into section 3, historic pressure, the yen under fire.
The USD to JPY pair is climbing steadily past the 161.90 mark, and the mechanics here are brutal but simple. The Japanese yen continues to just get crushed under the weight of the massive interest rate gap between the US Federal Reserve and the Bank of Japan. You see, even though the US dollar weakened in the short term right after the jobs report, the yen was completely unable to mount any meaningful recovery. The long-term trend remains heavily tilted in favor of a strong USD over the JPY.
And we're not just talking about a tough month here. Just last week, this currency pair touched 162.84. Just let that sink in for a second. That is the highest level we have seen in nearly 40 years. We are talking about a generational high here, representing a historic collapse in the purchasing power of the yen relative to the dollar.
Which naturally leads to what is probably the most dangerous question on the board right now. Will the Japanese government intervene? We are in a highly sensitive price zone. The market is watching the Bank of Japan like a hawk, because if the USD/JPY pair continues to surge, the risk of government intervention absolutely skyrockets. And make no mistake, any official intervention could trigger terrifying market sweeps, plunging the pair by hundreds of pips in a matter of minutes. Trading in this zone right now requires absolute precision and extreme risk management.
All right, let's cool things down a bit and look at section 4, the waiting game, featuring the euro and the New Zealand dollar.
The euro to USD pair has dropped and essentially stabilized right around the 1.1422 mark. Now, the euro actually saw a pretty significant initial rebound when that US jobs data dropped, but that momentum completely evaporated. It's turned back downward, slipping right back into its previous sluggish trend. And the main problem? There is absolutely zero catalyst. With the European Central Bank widely expected to keep rates unchanged this month, they're leaving the euro without the fuel it desperately needs to break out.
While the medium-term outlook for the euro might remain mildly positive, the excitement we saw last year is just gone. It's down over 6.2% year-to-date. Meanwhile, the New Zealand dollar, currently hovering around 0.5683, is also paralyzed. The NZD has weakened considerably and is sitting entirely at the mercy of the upcoming policy decision from the Reserve Bank of New Zealand. If the RBNZ delivers a dovish signal, you can expect the NZD to face immediate and heavy downward pressure. Essentially, they're just waiting for permission to move.
Let's tie this whole thing together in our final section. Section 5, market rebalancing and the next move.
If there's one overarching theme you should take away from this explainer, it's that the global Forex market is in a massive tug-of-war right now. The initial shock of the US jobs data has been absorbed, and traders are actively repositioning their portfolios. The market is effectively holding its breath, it's consolidating its positions, and it's waiting for the next major fundamental trigger to dictate the broader, long-term direction of the US dollar.
And the good news is, we know exactly what those triggers are. Consider this your actionable checklist for the days ahead. The entire market is laser-focused on 2 upcoming catalysts, the release of the FOMC meeting minutes and the latest US inflation data. These 2 specific data points are going to give us the critical clues regarding the Federal Reserve's true interest rate trajectory. Basically, they are the keys that will unlock this current market stalemate.
Which brings us to our final thought. As this rebalancing phase concludes and those inflation numbers finally hit the wire, what happens next? Will the US dollar use this stabilization period to launch a massive technical recovery and crush the majors once again? Or is this just a brief pause before a much deeper structural weakness resumes? The board is set, the catalysts are fast approaching, and the next move is going to define the quarter. So keep your eyes glued to the data. Thanks so much for joining me on this explainer, and I will see you next time as we continue to decode the markets.